The 2000 dot-com bubble remains the ultimate case study in irrational exuberance. It was an era where a business plan was a napkin, a dot-com suffix was a golden ticket, and the laws of financial gravity, specifically those governing cash flow, seemed temporarily suspended. But on March 10, 2000, the NASDAQ peaked at 5,048, a staggering 400% increase in just 5 years. At the height of the mania, companies with zero revenue were being valued more highly than established industrial giants like Boeing or Ford. As John Cassidy notes in Dotcom, it was the moment America lost its mind, trading the boring reality of price to earnings for the intoxicating dream of eyeballs and clicks. The dot-com bubble didn't inflate in a vacuum. The mid-90s saw a convergence of 4 transformative forces. The first one was the technological breakthrough. The 1995 Netscape IPO proved that the internet was no longer a playground for academics. It was a brave new commercial frontier. The second factor was monetary ease. The Fed under Alan Greenspan kept interest rates low. Further, capital gains taxes were lowered with the Taxpayer Relief Act of 1997, flooding the market with cheap capital. The third force was democratic speculation. The rise of online brokerages such as E-Trade allowed retail investors and day traders to bypass the gatekeepers and join the speculative frenzy. The fourth force was the media, which sold financial news as entertainment. Robert Shiller's irrational exuberance shows how the media bulls such as CNBC were not impartial reporters of the dot-com bubble, but self-serving salespeople adding gas to the fire of wild speculation. If you are familiar with financial history, you are scratching your head now. Aren't these 4 drivers of the dot-com bubble very similar, if not identical, to the ones we saw in the 1845 rail mania and the 1929 New Era mumble-jumble? Yes. And we might be watching this very same movie again today, as AI is broadly hyped in the press. Everyone is selling AI today. But back to dot-com, and how it inflated. Brunemeyer and Nagel point to something funny. Sophisticated investors did not go against dot-com. They actually rode it. Hedge funds chose to profit from the momentum rather than playing it safe. In short, hedge funds did not hedge. Companies like Pets.com and Webvan spent millions on Super Bowl ads and massive warehouses before a single profitable quarter. Wall Street salespeople ignored traditional business metrics, focusing instead on eyeballs. By late 1999, cracks were visible to those willing to look. Ofek and Richardson point to short sale constraints. It was physically difficult and expensive to bet against these stocks, meaning only the optimists were setting the prices. Valuations were ludicrous, and the average PE ratio for the NASDAQ reached 200. Insider selling picked up as lockup periods for startup employees expired and many quietly cashed out. And then, after the turn of the millennium, it all blew up spectacularly. The dot-com bubble popped not with a bang but with a whimper. It was a slow-motion train wreck. In March 2000, the Fed raised interest rates. At the same time, Japan entered a recession, and a famous Barron's article titled "Burning Up" revealed that most internet startups would run out of cash within months. Panicked investors realized that eyeballs didn't pay the rent. From March 2000 to October 2002, the NASDAQ crashed by 78%. Erasing roughly $5 trillion of wealth. The fallout was uneven, creating graveyard names like eToys.com and Pets.com, which liquidated 9 months after its IPO. But dot-com also forged some of the titans of the next decade. Amazon shares dropped from $100 to $7, but survived. Many retail day traders lost their life savings in busted tech stocks. Only those who sold before the turn of the millennium did well. And sober investors who had been mocked in the late 1990s, such as Warren Buffett and Jeremy Grantham, had the last laugh. The legacy of the dot-com bubble extends far beyond the stock chart shown here. First, Humbert and Maitre show that workers who started their careers in the tech sector during the boom experienced long-term wage scarring, earning less over 15 years than peers who started in other sectors. Second, a positive consequence was the infrastructure legacy. While investors lost money, the fiber optic glut created during the boom laid the groundwork for the high-speed internet we use today. Third, the Dotcom Bust contributed to the passage of SOX, which improved corporate governance. Finally, it created a decade-long sobriety mood in Silicon Valley, where profitability finally became cool again. At least until the next hype cycle. Is it possible that some of the same dynamics appear today in the context of AI? Ask yourself not whether AI firms are experiencing more eyeballs. Ask yourself, how many eyeballs are actually paying for the AI they are using? Our verified sources are here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. History may not repeat itself, but it certainly rhymes. In financial markets, the rhyme usually reappears a few decades after the previous blow-up, at which point everyone who lost money are either retired or dead. But the generation of investors that comes next ignores history. This is why we see the 1845 tech bubble reappear in 1929, and then again in 1999, and then today with the AI tech hype. Jeremy Grantham, one of the few level-headed investment minds during .com, recently published this, which we recommend to all viewers. This is one of the best detailed accounts yet of the Minsky model, which we have examined in our channel, and which explains quite well the tech bubbles of 1845, 1929, 1999, and today's. But as usual, do not take our word for it. Do your own work and come to your conclusions. Godspeed and stay out of financial trouble.